This week we studied chapters 3 and 4 of the text. So this is our second lesson now. Chapter 3 introduces the double entry accounting system. In order to accurately capture the vast number of financial transactions that a business engages in each year, a system was introduced over 500 years ago. This is what we today call the double entry bookkeeping system. It is somewhat like the traffic laws that keep cars and people flowing in Los Angeles, inasmuch as they do flow. Red means stop, green means go. In our analogy, this would be debits and credits. We begin with the accounts. An account is an individual record of increases and decreases in a specific asset, liability, or equity item. We saw a list of accounts used in the balance sheet report in Chapter 2 on page 75. Note that there are three classes of accounts: assets, liabilities, and equities. For teaching purposes, we display these as T accounts, so called because they resemble the letter T. In actual practice, these accounts are managed by computers and no longer take physical form until it is time to report the account balances. The terms debits and credits refer to the left side and right side, respectively, of each T account. The fundamental accounting equation guides us when recording increases and decreases in an account using debits and credits. For all asset accounts, a debit represents an increase, and a credit shows a decrease in that account. Both liabilities and equities are exactly the opposite, with credit entries showing increases and debits showing decreases in these records. Asset transactions are categorized as source, exchange, and use transactions. The text gives several examples of each. Note that every transaction involves two or more accounts. One account is debited, the other is credited. We call this system double entry bookkeeping. Note that each transaction is presented in a horizontal format, which emphasizes the accounting equation. This is to help you understand the effects of each type of transaction on the financial reports. The process of generating data to be entered into the accounts begins with the source documents. These include sales receipts, invoices, checks, time cards, deposit tickets, and so forth. Every transaction must begin with and be backed up by a source document. These are stored until they can be legally shredded, generally a period of 2 years or more, as dictated by the IRS. Each transaction is recorded in a journal, which is called the Book of Original Entry. This allows the accountant to track every transaction chronologically, that is, across time. The increases and decreases for each of these transactions is then transferred into the separate accounts. The collection of all accounts is referred to as the ledger of accounts and is therefore called the Book of Final Entry. The process of transferring data as debits and credits from the journals to the ledger accounts is called posting. When this is done, a systematic cross-reference is recorded so that each account can be traced to a journal record of its transaction, which can be supported by a source document. This allows auditors to check the accuracy and reliability of the financial reports based on the accounting records of a business. The trial balance is a tool for checking the accuracy of the accounting record. It is based on the fact that total debits and total credits recorded in the ledger of accounts should be equal, or therefore balance, hence the term balancing the books. At the end of each accounting period, at least once a year, the accountant closes temporary accounts by transferring their balances to permanent accounts using closing entries. The final balances are recorded in the financial reports, a trial balance is performed, and the cycle begins anew. Wash, rinse, repeat. Finally, the authors introduced the subject of financial analysis by showing how the accounting records and reports can be used to judge the financial health of a business. The purpose of Chapter 3 is to give you a conceptual overview of the recording and reporting process. The actual bookkeeping is now done by computers, of course. The work was once done by hand and involved much more clerical labor than it takes today. Chapter 4 shows accounting for merchandising business. These are commonly either retail or wholesale businesses. A key feature of this type of business involves accounting for inventory. Take note of the learning objectives for the chapter found on page 188. We start with a discussion of the perpetual inventory system. Later, we will introduce alternatives. Right now, our goal is to accurately measure the cost of goods that are sold. The difference between revenue from sales and inventory and cost of goods sold is called gross margin, or gross profit. We then subtract selling and administrative costs from this figure to find taxable income. After paying taxes, we are left with what we call now net profit. The goal of every business is to make this final number as large as possible. Economists call this activity profit maximization. The balance of the chapter details transactions affecting inventories and sales and their effects on the income statement and balance sheet. So this concludes our discussion of the the second lesson. If you take a look at the lesson 2 outline, which you should bring with you to class, by the way, we have a list of learning objectives covering both chapters 3 and 4. And then some reading assignments. Read chapter 3 and read chapter 4. The little outline that I furnished will also be given to you in print form so that you can refer to it as you study. It should help to simplify things. And I believe I've emphasized in my brief talk here all of the important materials. And finally, the learning or discussion questions take the form of problems from the back of the book. From chapter 3, we have a half dozen or so small problems, one larger one. And then from chapter 4, we have a similar number of problems for you to complete and post. Congratulations to those of you that have already posted answers. For the most part, they have been totally error-free and very, very well done. Pleased to see that. Keep up the good work. Keep up your spirits, and look forward to seeing you in class again. Hope to not only educate, but maybe somewhat entertain as well. We'll see you later.